So, welcome
yeah, yeah.
everyone to our spaces. Today we'll be hosting Ravindra sir. He has a 10 plus years of experience in capital market. As far as his education background is concerned, he is CFA, FRM, and he did his PGDM from Xavier's Institute of Management, and he is a MS Finance from IBS Hyderabad. Apart from that, and this is, I mean, he is more into reading, and he also run a YouTube channel which he started some time back, and he usually share his experience, rich experience basically, and he also do blogging. So previously he was into equity research and portfolio management, and so we'll be interacting with him and we'll try to know the general investing framework which he uses and what all approaches one should keep in mind while constructing their portfolio. So there are many questions that would be coming our way. So over to you, Ravindra sir. I would request you to introduce yourself to the audiences, please.
Yeah, thanks AI. Thanks for nice introduction. Yeah, about more than 10 years of experience, education background you have already mentioned. Basically, what I follow in capital market in investing framework would be growth at reasonable price. So we will seek out for ideas where we think that the growth is less than decently priced right now, and there is opportunity to make money. About my profile, I'd say I've done different kind of work. I've been part of investor relation teams earlier. I've done equity research, was part of a family office and managing investment. So being in different profile of capital market, understand companies, communication, and capital market from inside as well as outside. So we used to see how company will portray their
I
financial results and
so-
communication to the capital. Hello,
sorry to interrupt. Your voice is breaking. Kindly check.
just a second, just a second.
It's better now.
It's better.
Yeah.
So was able to see the communication from inside when was part of IR of companies, and then when we're part of sell side and say family office, we are able to see how the communication should be seen from outside. So it helps in terms of getting the right perspective, dwelling in depth from the what company is trying to convey. And as I said, been more than 10 years experience in the market. So invest in all kind of assets, all kind of sector, apart from one or two sector where I think the understanding is very low, chemical and pharma. Otherwise, yeah.
Okay. Basically, if we request you to tell what should be the ideal approach to construct a portfolio.
I can say what I my approach is, and then people can question and think if it works for them as well. So what I used to do for my portfolio construct is, say, two-third of the portfolio, 60-65% of the portfolio is normally consists of a known business which are available at decent valuation, sometime maybe at a higher valuation, something of the larger private banks, the FMCG, and basically the Nifty 50 renowned name. Whenever they came at a decent valuation to top up, so I buy those as my core portfolio that construct about 60-65% of the portfolio. Then there are the mid cap or even dislocated large cap ideas, which I take in terms of next to core portfolio. You can call it a satellite. People call it core and satellite. So 30, 25, 30% of that would be kind of satellite portfolio, and then I keep some 5-7%, 10% at max to something which is booster. It's like weird kind of ideas which can, if they work, they can really give you very high return. In this, you can even select companies which is not great pedigree, have done something in the past, but right now your framework, your thought process says that there is huge value in the business, and you can take 1-2% of your bet in the portfolio. So normally keep 25 30, 20 25 30. That is a broader range of investment. I used to keep only on the equity side I'm talking about, and manage investment when you see that the risk looks very high. Then you focus more on the core side where you see the downside on the on later on might be lower. But say right now there is a decent correction in the wider market, so you pick and choose those companies, and there is enough opportunity right now you can gauge from the correction. So basically constructed the portfolio is 60-65% is the core portfolio. Over a period of time, 5 years 7 years, they come back and perform really well. The return expectation is not very significant for these kind of stock. The basically our return expectation is sets portfolio construct, right? So if you mind, I can speak a bit about return expectation here.
Yeah, sure.
So how my return expectations from market is, say India, we are about 6% kind of growth economy, real GDP growth. Up on top of that, you will experience 4 to 5% kind of inflation. So a nominal GDP growth of India is somewhere around 11%. And profitability growth and your stock performance can be 2-3%, 4-5% higher. So normal construct for our decent portfolio should be 14-15% CAGR for next 10 years. If you build your portfolio with this construct in mind, there is lots of opportunities which are available at decent valuation. This I am talking about core portfolio. Then you come to the satellite part, which is the next 25-30% of the allocation. There you find some few mid cap ideas where you feel that there is decent probability that it can be 2x in next 2-3 years. There's something wrong which is going on because the stock, because of that the stock is deeply undervalued, and when the tide turns, it can give you much higher return. But then these are smaller companies and you don't want to take something kind of disproportionate bet here. You don't want to bet 8-10% in these kind of stock. So you take 3%, 5% kind of allocation here. And then the last piece which I talked about is the booster side of portfolio, where you take where they are maybe unknown name or shady name, or a concept of idea which is building up. So there you take 1 to 2% depending on your conviction, and you see whether the idea is developing as you think. Yeah, yeah, yeah.
Yeah, sure. So basically, when we talk about if we talk about current market scenario, so we try to find out the sectors. I mean, basically where pessimism is in place. So, I mean, how you? I mean, what is your approach to go about which sectors to fish in? And I mean, what is your approach to find out as you were telling the valuation front? I mean, am I
Okay,
clear with
okay.
my question?
So basically, what we are trying to delve here is which sectors right now looks attractive for a medium long term investment. Is that
Right,
the way?
right.
Okay. So first and foremost, which comes to my mind is large private banks. Say India can't grow. India can't be a 5 trillion economy from only consumption where banks is not participating. Bank has to participate. The production, the manufacturing, industrials, those facility has to go up to support the consumption. Which India has been a consumption-led economy for a very long time, last 4-5 years. But then the banks also need to participate, uh, and they are right now. I'm only talking about the larger private banks, because there's one distinction here among the larger universe and say the smaller universe, that you first identify whether this bank will be a relevant player uh, 10 years down the line. If you see there is a question there, then their valuation is quite different. So if you pick any small private bank down south, their valuation versus the bank which is pan India present and has a dominant presence, their valuation benchmark is completely different. Okay, so you pick that large private banks which you think will be a relevant player 5 years, 10 years down the line in India, which will continue to remain a dominant player. The second thing which I look at banks is what kind of growth they are doing right in the recent past. What is the management projection? what kind of return they are expected to generate, ROE, and what kind of valuation they are trading at. Say if I, without naming, if I say two large private banks in India, they trade at something around, they you can generate 14-15% kind of growth from there. They recently must have generated above 20%, but they are expected to generate 14-15% for next 4-5 years, and they generate 14-15% kind of ROE. And if they are available at 2.5x or 3x kind of valuation, so they are decently priced. Let me explain a bit why I say them are decently priced. Say if you pick both the larger banks historical average, they would be around 3.5, 4. Okay. And compared to what they used to grow in last 10 years, they will continue to grow for next 10 years. But last 10 years they were trading at 3.5 or even higher valuation. Right now they are trading at 2.5 types. The first thing, that indication tells me that the valuation is bit corrected right now. The second thing, benchmark, you see, say you compare it with the India's yield curve. Say right now, our risk-free rate is about 7%. Right now, it is elevated to 7.4. But say for next 10 years, we expect the risk-free rate in India again will come back to 6.5. So if anything which is generating 14-15% kind of return, it is expected to remain at 2x kind of book value. So in that sense also, I don't find them as extremely overvalued. Other sense which we draw is the entry point. Say this two concepts tell you that these are decent company to hold for next 10 years. Then the other question comes whether I buy immediately or how should I plan my buying. Say I've been buying for a very long time, but right now what becomes more interesting is there is continuous FII selling in Indian market right now. Say last 4-5 months they have sold about 1.5 lakh crore, and their holdings in large private banks has been very high. So if a person which if there are shareholders with 50-70% investment stake in a bank and they are selling, then domestic mutual fund which holds 5%, 10%, 15%, they can't protect that downfall, the steep downfall which comes. So it gives you a good timing also in terms of entering if you have already not entered. And if you have already entered, you just anchor that, okay, this is my allocation, this is my percentage. Right now, it trades at this book value. I think it should give a decent return in near future. So first thing which comes to mind is private banks. Sorry,
Yeah,
you
I
had
have
any
a
question?
follow-up question on banks. Like, where you see we are in credit cycle?
Yeah, credit cycle. Look, two three things. It's a bit complex. The thing is, we say not India, world over. Say world for last 4-5 years, we have only seen monetary easing. India has been doing fiscal spending, but now the world also is coming together in terms of everyone wants to, apart from monetary easing where they are tightening now, they are doing fiscal easing as well. They will do projects and those sort of stuff. The second thing in India is uh, all everyone is trying to do more and more on the retail side where they say there is huge opportunity, but there has to be opportunity on the corporate side as well. Say, let me take a name. HDFC is now very aggressive on the corporate lending as well because the entire banking space has vacated that space, and you get a better pricing when all your competitors are running towards different direction, and you find a sweeter pricing mechanism because you are only one aggressive on that side. Other thing is, say for last 7-8 years, where you need is spending in terms of corporate. There are couple of sectors where you need spending. One is cement, steel, power, and infrastructure, general government infrastructure. Steel, we haven't seen any investment for last 8-10 years. Any significant investment for last 8-10 years. Same is for steel, same is for power, same is for cement. So, what we were dealing till now was low capacity utilization for these prominent sectors which ask for credit and fuel credit growth in India. Now, the capacity utilization for these prominent sectors, at least I can say for steel and cement, They are at 75, 73% kind of level. And those are time when you start thinking about capacity expansion. Power, I will not say still they are on that mode. The reason is power also you have to buy. Look, in research, everything you have to keep on peeling the onion till you understand the entire piece. Power, the thing is, there's a two side of story. One is on the thermal power, there's no expansion, there's no, there's even every year there is reduction in PLF, what we call capacity utilization, plant load factor. There is continuous reduction there, but there is huge expansion which is coming on the renewable side. So there also there is capex which is happening, but it is only on the renewable side. So all these things tells that still that 14-15% at least, and for larger banks it will be much higher because they are right now very well capitalized. You pick any large bank, they are sitting on 17-18% minimum capital adequacy, and then their provision from previous bad loans has been very much well provided. You pick any name, it will be 80-85% kind of PCR ratio, which tells you that you should, if the demand comes back, you are ready to pounce on that demand. Till the steel players, the cement players, the power producers are not going on aggressive in terms of capacity expansion, then itself the growth is not coming in terms of credit growth. But they are ready with their ammunition, because their credit adequacy is very high, their provision is already from previous bad loans is fully covered, so they are fully ready in terms of grabbing the growth whenever it comes. Yeah, 15 14 15% kind of growth from large banks is minimal requirement, I think. Without that, India will grow very slow. Yeah, these large 8-10 private banks cumulatively had to grow their credit by 14-15%.
Right, right. So, do you have any view on PSU banks as well?
PSU Bank, I like few of them. Definitely, I like SBI. But since your invest, look, you go in PSU, when you see that, say, HDFC, if it goes above 4x, 3x book value, trailing, say 4x, if HDFC goes as 4x and SBI is available very cheap, then I will look there. But right now, HDFC itself looks very cheap, and to an extent, I believe I understand the reason for it available right now very cheap is there is strong selling from FIIs, which is more and more, I think to believe it's a passive selling, say MSCI based selling or JP Morgan index fund based selling. So their stake in, say, HDFC Limited, the parent company, has come down from 70 to 73% to 67% right now, and that kind of aggressive selling in just a span of 2 quarters. And that is the reason why. And one thing, other thing is, when index selling, passive selling, and FI selling happen, they don't see price. They don't say that, okay, it is available at decent valuation, this is not the right time to exit. This task is more from the Indian investor side. There is more strategic. Right now they need to sell because of redemption, or maybe their intention on emerging market is changing. So when I'm getting a decent entry point in a larger banks, I took a name of only two, but there are other banks a bit smaller in size. They are also available at very cheap valuation, and they also are continuously communicating that they will continue to grow very strongly in future. So right now, I don't see too much on the PSU side. Other thing, what stops me in the larger PSU universe is this piece. Let me explain a bit. Look, the banking, the core banking is fine. Core banking will become commodity, but you need to invest. All these larger banks are continuously investing on fintech. They have the next source of growth. Say next source of growth for banking would be insurance, AMC, financial services. You have to be very strong in those uh, sector, so that cumulatively your banking stock do well. But the other PSUs, apart from SBI, they don't have this other growth engine growing a lot. They are present, but they are not in that kind of competition as the private banks. So I stick to private banks, and SBI, the firm belief is they operate very much like a private bank. They are as strong as a private bank. So as an investment, I like that.
Okay, thank you. And I would like to tell everyone any names taken during the discussion are
Yeah, yeah,
only
yeah,
meant for
yeah.
educational purposes, and we are not here to endorse any company or any source. And
No,
we
no.
may or we may not hold any position in such names. And apart from that, Ravindra, I would also like to know your view on auto and its allied sectors, auto ancillary basically. So you have any view over those sectors?
Sure, sure. Yeah, as AI mentioned, yeah, none of these stocks which actually I should avoid taking names, but without taking names, you can't explain what you are trying to. Okay, so none of these companies are investment advice. I'm just sharing what I think about it. You can do your own due diligence. And anyways, yeah, we are very, very minuscule small investor. Me buying or selling or you buying or selling HDFC will not move a needle. So, anyways, that keeps aside. It's not an investment advice. This is just sharing the knowledge. Coming back to auto sector, yeah, I think it will do very well for next 2 3 years. A couple of things. Say auto sales in India. Say if I pick two-wheeler, two-wheeler last time we sold in 2019 was about 2 crore two-wheelers in India. Okay, now that sale is about 1.3 to 1.4 crore. This kind of sale we achieved at least in 2014-15. So we are back by at least 5 6 years in terms of volume sales in India for two-wheeler. The same is the problem for the four-wheeler and CV. CV might be even back. So we are right now we are selling what we used to sell at least 5 6 years back. So when Indian economy was about 1.2 trillion dollar, that kind of auto sales which was supporting Indian economy, right now we are witnessing that sales. Couple of reasons for that numbers to be very low for auto is, first thing is there is huge acceleration in terms of prices, be it because of government regulation, be it because of commodity price inflation, and be it because of COVID as well, where people are trying to spend less and save, more particularly on the rural India. So the sales which you are seeing right now is what you used to see 4 5 years back. Now when economy is also opening up, school colleges are again fully open. At least IT job, I what I hear is everyone is reporting 2 3 days. They have come back to their base location. All these things helps in terms of sales for rural, for two wheeler, and to some extent every class of auto vehicles. So once that sales come back, you will see the increase in revenue, you will see the increase in volume. The other aspect which is again hurting is the raw material prices, be it steel or any other raw material. So that is, I can't say it's temporary, because I used to feel it was temporary a year back, but it has further gone up. So let's see till how long we can sustain that kind of commodity prices. But even with that high commodity prices and so low volume, if you see, if you try to pick any auto OEMs on Screener, everyone must have seen Screener website. You see what margin they used to generate when they were doing in 2017-18 much higher volume. So the margin dip is 3 4% only, if there is any. So once the volume come back and they are able to say retain some amount of pricing power, you will see margin again as well. And now the coming back, the valuation is very cheap. At least for two wheeler, it's very cheap. Four wheeler, it's a bit expensive, but then the competition on the four wheeler side is very low. That's why it is that way. So I too have very strong view on two wheeler. I keep on posting something about two wheeler. I expect them to do well for next 1 2 year. And apart from that, there is one more concern on two wheeler side. It is on the EV side. Actually, I did once Twitter space few months back on this EV as well. What my thought here is, say you go anywhere in the world, pre EV time, you would see every geography will have 3 4 5 companies only. You pick two wheeler, you pick four wheeler. The reason is, you having just a product is 20 25% of the work for a auto. Then the work is about getting the right distribution right, building the brand right, that your customer actually have that kind of appeal from the brand, then having the after sales service right. And this takes time, it takes decade for to build for those companies. It can't be replaced all of a sudden. And all these companies, they are sitting on say 20-25% of their market cap in terms of cash. They will not let go if they see the opportunity is building up so large. They will not let go this opportunity. Having a product right is 20-25% of the work. Having the distribution right, building the right brand. Say Hero has built that brand in the rural India. It doesn't sell that much in urban India, in upper middle class, upper class pocket, right? But building that brand as a very sincere recall in rural India, that also took a very long time. You can't replace it with new players coming in where the promise of delivery is in terms of services is not present right now. So I think these larger players, they will come back. And think about this as well. Say earlier when two wheeler was selling or even four wheeler was selling, the value creation for any auto vehicle for manufacturer was happening only at the sales point of time and their whatever services they are selling, right? So say if a two wheeler vehicle was selling at 70,000 rupees, now the price point of that vehicle will increase a lot, because whatever value creation from the use of auto was happening because of oil, petrol, diesel, that is now moving towards the OEM side. So the volume will not decrease, the price will definitely go up, and I believe that they will still have a very high market share even when EV comes. So I'm a bit optimistic about two wheeler.
Yeah, right. Fine. Good analysis on this. So, guys, those who are new and not connected with our handles, I would request you people, if you find value in our spaces and our handles, kindly do follow us and spread a word. And apart from this, in few minutes, I'll open up the space for questions from the audiences. In the meantime, Ravindra, I have two more questions. One is how you, I mean, go about cyclicals, and second is what are the various ways in which newcomer to the market go about valuating, I mean, on valuation front? So these two questions, and after that we'll open up the space for audiences. Kindly send your request and we'll take up one by one.
Sorry, your question is on cyclicals.
Yeah, how to go about cyclicals. Yeah.
Yeah, cyclicals, as anyone will tell you, yeah. The thing is, you go when no one is right to go in that direction. You go into that party when everyone doesn't want to go. So that time was, per se, if the ultra cyclical we pick, say metals, that time was 2 years back. So one objectively how to identify a right time to grow. Whenever you see any metal production, the cost of that production is very much similar to the price which it is going to get, because beyond that it can't sustain its production. So that is the utmost best time to enter. Things are very bad, the valuation is bad, and the profitability generated from the company is very bad. So when you see, say, the cost of producing steel, aluminum, or copper, whichever metals you pick, or oil, the cost of production is very much similar to what price they are going to get from the sales. That is the best time you can enter. Maybe you would have to wait, because the cycle doesn't turn very fast here. It takes time. Sometimes it takes quarters, sometimes it takes years. But when the cycle turns in cyclical, the beauty is, even if you have waited for say 1 year long and you didn't made return, you even made some losses, and you added, because now there is a price, say cost of production is still high and the price is further falling down, and some companies are incurring losses as well. You keep on adding, because this things has to change, it can't continue in that direction. Similarly, right now the situation is, they are making the profitability is as high they made in last 20 years. They even didn't make this kind of profit when there was super cycle from China. But right now, let me give a disclaimer here, that the price of say cyclical companies and the margin are not matching. If this price, if say metal prices remain for at this level for next 2 years, these companies will make profit which is equivalent to their market cap. So no one is actually believing that this price will sustain. So every month you see the price sustaining at that, it means it should add at least 5-6% in the value of that market cap. So planning a cyclical entry is easy. Exit is very difficult, because right now, if you see the profitability of any this metal company or oil company, your instinct will tell you that if this price stays for another 3 months, I will at least get 6-7% as a dividend yield, which will be generated as cash from the company. So very difficult to say exit, but entry would be much simpler, because when you see cost of production being coming very close to the price, and market no one is talking about these cyclical companies, that is a good time to enter. Actually, that is way to pick sectors. Say right now no one is talking about auto. Auto been in dumps for last many years, 4-5 years. So there would be a time when this recovery will happen on the auto side as well.
Right,
Yeah.
right. So, what all valuation, I mean, ways, I mean, sector specific, or maybe you want to highlight on your part? Valuation is a very debated topic. It is, I mean, everybody talks about valuation, but not everyone is able to do it right. So,
Okay, yeah, it would be very difficult to explain, but say, let's pick a very simple sector, something like FMCG. So, how should one do a valuation? Is say you pick one company and you see what their average P multiple for last 10 years, though that might be also a bit elevated, but say you pick any FMCG, large FMCG, and see what kind of valuation they have been trading for last uh, 8-10 years. Say you pick HUL, you pick Nestle, you pick even smaller company like Marico or Dabur, and then you see what kind of growth profile they generated in last 10 years, and what is the expectation now. If that is not dented significantly, but P multiple is dented significantly, I think that is a good thing. See, I wrote a blog also on Colgate somewhere around last September, October. I don't remember now. So my thesis there was Colgate always used to trade at a multiple of 40-45 for last 8-10 years. Now the valuation is depleted to 35-37, and what company is still saying is they will generate a profit growth of say 7, 8, 9%. And other thing for depletion of the multiple was because of Patanjali, they lost market share. They lost from 58% to 48% kind of market share. But they are generating enough cash, whatever profit was generated. Say a 40 kind of multiple means you are generating 2.5% yield every year. And they were distributing that 2.5%. Their dividend yield is about 2.4, 2.5%. So there is nothing to doubt on the financial as well, and something available at 30 ka multiple growth. This is very saturated market. You can't grow more than 3%, 3.5% volume, something 2-3% inflation and 2-3% kind of value growth. You will migrate from a cheaper product to a higher value product. So you will only generate that 8% kind of 8-9% kind of profitability, 8-9% kind of revenue. Beyond that, you generate that 2-2.5% dividend yield. So this is a 10% return product which is available to you, and it is a counter availability towards debt instrument. It gives a very good protection when the market is down. Say from since that time, market must have gone down. Those high flying name has been down 20-30%, but Colgate has been stable. This is because entering and finding right value at the right time. Say even the larger companies, say Nestle and HUL. Nestle, I think there was hardly any time in last 2-3 years. It was before BJP again came to power. Nestle came back to 60 ka multiple. It was only beyond before that. It was only time when the Maggie crisis happened. They were trading at 50x PE multiple. So you find that they are available at attractive valuation. Otherwise, they used to trade at 75 plus kind of PE multiple. So you find that spot where you think the valuation is right to enter, and then you gauge whether the profitability is moving as per your expectation or not, and try to increase or decrease your position.
Yeah, fair enough.
So few things which you should definitely look out is, say, what kind of valuation the company historically been traded, and don't pick just 1 2 year cycle. Pick a longer cycle, at least 5 years, if possible go for 10 years. Pick that 10-year cycle, what the company was trading at in this 10-year cycle, and what it is trading at now, what the company was guiding in terms of growth now, and what it has been delivering for past many years. If there is stark difference, then you adjust your multiple accordingly, and this will tell you a better kind of, this will give you a better idea in terms of entry and whether your valuation thought process is right or not.
Right, Ravindra. So we have a few speakers in line, so we can take up one by one. Would that be fine, right? Yes,
Yeah, yeah, sure.
Satyendra, you can go first.
थैंक यू, नमस्कार रमन जी। मेरे क्वेश्चन था, वो देखिए अभी लास्ट 6 8 मंथ से जो है मार्केट एक रेंज बाउंड है। तो मैं ये पूछना चाहता था कि जो नेक्स्ट हम जब ब्रेक करेगा तो कौन से 5 6 स्टॉक या 6 7 जो लीडर होंगे और क्यों होंगे, उस विषय पे थोड़ा सा अगर आप बताएं।
या मेरे हिसाब से तो अगेन आई वुड थिंक दैट large private banks has to perform. They have some 20 25% weights, large private banks and their insurance arms. They are poised to grow for that. देखो ग्रोथ नहीं आती ना इंडिया में, वैल्यूएशन कोई नहीं देता. देयर कांट बी, अगर ग्रोथ 10% से नीचे हो तो वो गिने चुने नाम है जहाँ पे लोग फिर भी प्रीमियम वैल्यूएशन देते हैं. So these large private banks still can grow at 15% kind of multiple, and they are the one which will drive index as well because of their weight there, and they are not expensively priced as well right now. So I think those are good pocket to be invested. Again, the larger FMCG pocket is very attractive. Then there are few pockets in terms of industrials. Say power sector has been doing very well. The demand has been phenomenal. There is the demand would continue to be that high for next few years. The way India consumption is growing, and the valuation is again they're not expensive. Other pockets, is, as I discussed right now, I feel auto should do well. They have been not been performing of late. uh, Discretionary consumption, something like white goods. You see anywhere the demand of white goods will go through the roof once we have look in, even in white goods segment, you have huge amount of chip requirement and commodity inflation which is hurting them. So these are temporary phenomena, but the demand for white goods is next 20 years story. Whoever is using say a simplicity, for simplicity purpose, whoever is using say a 15,000 rupees ka refrigerator, he will move to a larger refrigerator from 15,000 to 30,000 and then to 50 60,000. So there is this upcycle will continue for at least next 10 15 years or year even beyond that. Even after that, the penetration say for a fan is only fan is about 60 80%, but this AC fridge is 20 25%. AC is even less than 10%. Fridge and washing machine is 20 25%. So there is huge catch up which is needs to be done on Indian household. Anyone who is using one AC will have a AC in their drawing room as well in next 10 15 years. So there is huge opportunity for demand to come from India on white goods side. Autos, discretionary consumption, banks, these are the sectors I'm very bullish on. Yeah, and I think they should contribute handsomely in terms of your portfolio return because they are not very expensively priced as well.
So, Ravindra, before coming to Rahul, I would ask you a question like just like you told about washing machines, air conditioners, and all. So, these have, I
Yeah,
mean, I mean, not about washing machines, but air conditioner have seasonal demand, right? So, how you
yeah,
think
yeah.
like the companies who are into air conditioner, what is the best time to get in?
Yeah, best time ऐसे बोलना it's will be very difficult यार to time that precisely. Say I saw a few news item last week only where one company reported sales and people are saying there's so much heat and say heat wave in the country while the AC sales hasn't gone up that dramatically and the stock price fell out. Okay, let me give you one antithesis to this logic. How does AC sales work is you are only seeing say March quarter sales number right now. March quarter is the when wholesaler is or retailer is actually clearing their last year inventory and wholesaler is just loading up for the upcoming season. What sales kicker happen is towards May somewhere when your old whatever you thought of selling for the season gets sold off very quickly, and then there is dearth of repeat demand, there is repeat demand, and there is dearth of supply is not coming fast. Then you see that there is whatever delta in terms of sales happen for any season happens at that point of time. This you should see, I believe you should see in the month Q1. But again, timing here would be very very difficult. Actually, for this, you can. I also post something on my YouTube channel. I posted few weeks back on Whirlpool. I covered the entire investment case for white goods and Whirlpool and valuation also. They trade at 3x kind of sales for last many years and available at that valuation. Growth prospects look very solid. So I think that is a good company. Otherwise, also there is few more companies listed in India for white goods AC. They are decent investment, but timing would be very difficult. You feel that a valuation from a yearly sales is good enough, even if it's a month of December. I do believe you can buy AC and fridge company even at that time.
Cool. And guys, like Ravindra has just started his YouTube channel and has posted 7, 8 good videos and consistently working on another video. So I would request you all to have a look at his YouTube channel. The link is given in the tagged thread above. And apart from that, I would request everyone to keep your questions. I mean, don't seek any tip kind of thing. Next, we go to Akash, Rahul, and then we will ask from Akash. Rahul, go ahead.
Very good evening to all. Thank you very much for giving me opportunity to speak here. Sir, my question is Ravindra ji.
Yeah, yeah.
This time there is a very bear market, and every trader and investor is a long-term investor automatically. But sir, what are the decisions and strategy that long-term investor that don't have patience this time right now because there is a new investor in this market. तो सर
Yeah.
इसके लिए क्या सर राय देना चाहेंगे कि लॉन्ग टर्म इन्वेस्टर्स को क्या पेशेंस रखें, क्या स्ट्रेटजीज हो, डिसीजन हो उनके कि वो थोड़ा लंबा होल्ड कर पाए इस मार्केट में. थैंक यू.
एक चीज है, दिस आई एम ऑल्सो लर्निंग. एक बंदा ना इन्वेस्टिंग सीखता 2-3 बियर साइकिल के बाद ही है. पहला बियर साइकिल तो उसको यही लगता है कि मेरा लक खराब था. When he first say anyone who started investing 3-4 years back, when he saw COVID, his first reaction would be मेरा लक खराब था, मेरे पैसे जल गए. Let me speak in English. I guess it will be easy for everyone. So the investor always, long-term investor always get matured after 2 to 3 cycle. When he sees 2 to 3 bear market, then only he gets matured. Before that, if there is any new investor on this call, I would recommend to practice this. 90% of your investment strategy go through mutual fund and passive investing index. 10% of your portfolio, your risk capital, you try it with your own strategy, whatever. If you are chartist, if you are a fundamental analyst, if you are following someone and you find his advice, allocate only 10, 12%, 15% of your capital with that strategy and test yourself out. Test yourself out for few years and see how you are performing. Analyzing yourself is also very critical. It's only after you see 2-3 bear cycle na, you will understand कि boss ऐसा तो होता ही है. One reason or another you will see downfall, and one reason or another it will come back again. So the problem would be if you over allocate to certain strategy sector, and if you are selling on the dreams, which many one got on, say, ये last 2 साल का bull run था. Problem is, in bull market ना, no one understand risk. You give up the risk as it doesn't exist. It's only the quality of your investment will only be reflected in a bear market. The quality of your investment doesn't reflect in your bull market. I keep on telling this wherever I work, that in bull market you get confused that whatever alpha you are generating, is it actually not alpha, it's beta only, it's market return. Everyone is making that kind of return. Only in bear market your alpha will be seen. Your quality of investment will be reflected only in bear market. And if you are convinced that these stocks are good, then only you will be able to hold on to them in the bear market. Otherwise, you are selling, it's very emotional. When you are seeing loss, it's very emotional to sell. But if you have done your homework, study well, you are very convinced about that stock, then only you will be able to handle on the bear market. Again, I repeat, if they are new investors, have large portion, try it with index funding, mutual fund. Those are very good option in India. Try out your strategy with a small amount and see how you are doing. Then only slowly build up. And keep in mind, you understand market after you have seen 2 to 3 bear cycles. Before that, you are not mature, you are not graduated from market. Only you see 2 3 cycles, then only you will say that whatever you decide can work on bull market and bear market.
Sir,
I'm not sure if this was your
last
question.
question.
हाँ बोलिए
Sir,
ना.
last
सर मत बोलो यार.
sir, what is the minimum years for a long term investor? Minimum term for मतलब minimum कितने साल के लिए वो इन्वेस्टमेंट करना चाहिए, लंबा इन्वेस्टमेंट जो.
यार देखो, जब तक अगर देखो वैसा है ना, बहुत सारे इन्वेस्टमेंट ऐसे होते हैं कि इफ यू से कन्विंस के 8-10% ग्रोथ आनी है और वो हर साल 2 साल आ रही है, ठीक है, बट योर स्टॉक प्राइस इज नॉट मूविंग, then you say that might be the problem is with the management or something. But otherwise, if your stock is performing and company is performing as it is, there shouldn't be any exit strategy until unless you find something great. What I do is, say, if the company is moving in the direction which I am thinking, decent enough, थोड़ा ऊपर नीचे चलता है, स्टॉक चले नहीं चले, if there is external reason स्टॉक नहीं चल रहा है, वो अलग कहानी है, but company is doing what it was expected to do, I will not sell until and unless I find very attractive opportunity other side इसको बेचने के बाद. Rather than buying and selling, think about switch. Say if you simultaneously say Nestle versus HUL, don't take it as an investment advice, but you see how Nestle was doing for last 10-15 years, what valuation it used to trade, and what valuation HUL is trading. HUL must be 8-10%, 15% below its average PE multiple, and Nestle is higher. So even I hold Nestle, but the thing is, if I see these distinction, कभी कभी दिमाग में आता है, I should have switched now. I can switch now. But otherwise, if thing is happening as I expected, there is no point in selling.
I hope that answered his question. So next we have Akash in the line. Akash, unmute yourself and ask your question, please.
हाँ सर, मेरा क्वेश्चन ये था कि जैसे टाटा ने अभी कंप्रेसर बनाने शुरू कर दिया इंडिया में, सो इससे एसी मार्केट पे क्या पॉजिटिव इफेक्ट पड़ेगा कि टाटा मोनोपोलाइज कर पाएगा?
I'm not aware of this entire development, but anyone who is, there is another listed company LG बोल के है, वो बनाती है compressor. But anyways, if compressor is and even Hitachi is expected to say they will manufacture compressor and other parts which they were importing earlier. But if Tata is also say manufacturing, it's a very competitive market यार. वही 12-13% का EBITDA बनता है, ज़्यादा कुछ होता नहीं है. Say companies which is not into very aggressive in brand, they will generate a single digit EBITDA margin. Otherwise वो 12 से 15% EBITDA margin बनता है. There won't be much changes there. And brand holds the sway यार in terms of pricing. Say a few of the unlisted name, Daikin and all, if you see their product quality and pricing power, it's phenomenal. It's not run of the mill product. Brand holds the sway in India. So it will not, and they also have a bulk purchasing power. So will be difficult for a B2B player to curve into the margin of say brands.
Sir,
And
is it a good time to switch from metal companies?
sorry.
It is good time to switch from metal companies like Tata Steel, Hindalco, something.
Yeah, switch नहीं to at least you can't have over allocation there. You see what allocation index have some 6-7% होगा. और आपके अगर because people who have made money in metals, they must have gone blind with what the upcycle has done to them. So you don't have very high proportion, at least I would say 20-25% होगा ना, then you will have a very high drawdown. देखो metals ना बहुत binary हो गया आज के दिन में. If war comes to an end, then metal file prices will fall dramatically. Right now no one knows what's happening on war front and China, right? Metal price is very elevated. अगर एक क्वार्टर दो क्वार्टर और चलता है ऐसे प्राइस पे, टाटा स्टील एटलीस्ट जनरेट समथिंग 5,000 करोड़ एक्स्ट्रा कैश. लास्ट ईयर से इस साल उसने 40,000 करोड़ का डेट रीपे किया है. एक लाख करोड़ के आसपास, 1 लाख सवा लाख करोड़ का मार्केट कैप है. एंड इफ द कंपनी इज एबल टू पे 40,000 करोड़ काइंड ऑफ debt in a 3 years profit, if the price steel prices remain where it has been, if the steel price remains at the same level, it will generate the entire market 3 years. So and no one is forget about me yaar, no one has any clue what's happening in China, what's happening on the war front. They see price movement in last 5 days and then they predict. The only thing which everyone knows is the price is very high from their historical level. एक टाइम होता था when Tata Steel EBITDA per ton used to be, अगर 10,000 पहुंच गया इंडिया ऑपरेशंस का, they used to be, it's very high. We never seen this kind of profitability. Right now they are generating some 17,000-18,000 rupees per ton. Say if I rewind back, say a time in 2015-16, companies were bleeding because of China dumping. What these metal companies did was gone back to government and asked for anti-dumping duty. Government came forward and supported these metal companies. Right now, you are making so much money that the entire other spectrum of the industry is hurting. Autos, whoever is the real estate, whoever is consumer of metal is saying there is huge inflation which we can't bear right now. Isn't the role of government again come back to support those industry and say that the metal companies should curb prices? I don't know what will happen, but I'm saying that the prices are way too high for metal companies right now. But again, saying that the stock price is not reflecting this price. If the price remain for at least 6 months, 10% भी यहाँ पे नीचे रहा ना metal price, all these companies will generate something 15-16% of their market cap as cash, which is way too high. So you don't exit altogether. Keep on watching the development यार. Next अगर यहाँ से मेटल प्राइस कुछ 8-10% कम होते हैं एंड देन एनीवेज प्राइसेस पहले रिएक्ट कर जाते हैं स्टॉक प्राइसेस फॉर मेनी कंपनीज हैज फॉलन व्हाइल मेटल प्राइसेस आर वेरी स्टेबल, जस्ट कम डाउन 8-10% from their peak. Don't have over allocation towards metal here, I would only say that. Hello.
Yeah, Ravindra. Yeah. So next we have Hitesh with us. Hitesh, unmute yourself and ask your question. And I would also request other listeners, if they have any question, please come up with us and ask your question and add value to our spaces. And definitely you would be liking the knowledge shared by Ravindra Bhai. And so I would request each and every one of you to go and check his handle and YouTube channel. And if you find any substance, so we request you to kindly associate with our Twitter family. Thank you. Over to you, Hitesh.
Yeah. One more thing. I actually, in my Twitter handle, I have mentioned YouTube channel. You can watch from there. Yeah, continue.
Yeah, hi Ravindra. This is Hitesh here. We just connected some time back as well, and recently I just came across your handle as well as YouTube channel. So that's pretty good actually. So my compliments to you on that. It really does add value to your readers and listeners as well. My
Thanks.
question my question is around say kind of say kind of maybe hedging, or maybe how do you deal with downturns, etc. Say for example, okay, you're 100% invested, and say you expect that okay, maybe the markets are heated, the valuations are very high, so maybe okay, what strategy do you adopt at that point of time? So because say kind of primarily being a small cap and a mid cap investor, say kind of I whenever I feel that okay, markets are a bit overheated, or small and mid cap segments are a bit overheated, maybe I use a combination of say kind of maybe moving to cash and maybe utilizing options as hedges, or say kind of moving some money to say kind of maybe uh, decent large cap at decent valuations, etc. So I use a mix of these things, but I'd like to
Yeah.
hear your views on this as well, please.
Yeah, look, the thing is, hedging doesn't come without cost. Yeah, there is too much cost. If you want to hedge your portfolio, and if you want to hedge only for a say 1 month, 2 month time frame, then only it will cost you 1-2%. But longer time frame, you can't hedge a portfolio. It costs very heavily. Even if you buy put or do whatever you are trying to do, the hedging doesn't come very cheap in India. The volatility is very high. The second thing is I also adopt this thing here. If look, everyone makes mistake, right? There is nothing in saying that you don't make mistake in a crazy bull market. Even sometimes you feel that this thing is working right now, this is on a bull run, and it will continue to run for next few days. At least you will get an opportunity to make money and move out. You allocated small amount in that particular idea, okay, and it didn't work, and now that is say 20%, 25% down. You don't have any view to hold on. Yeah, the problem is, say if I invested in those ideas right now, if they are not working, I don't have any view why they will work in a longer time frame. My only view was it is going up and it will go up. The best medicine to this is, first, plan your entry accordingly. Say if you're riding on those kind of idea, don't allocate more than 2-3%. Other thing is, if you see market is overheated, the best thing is move to a larger cap, which is a renowned name available at decent valuation. Yeah, you can pick lots of companies from Nifty 50 right now, which are available at decent valuation. If this mayhem in the market continue, you will see that at least your capital is protected.
Right, yeah.
If you see that market mayhem continues, at least your capital is protected, because in the ideas in which you don't have very strong belief, uh, your capital may run very haywire. There are few people who will make 2x on those ideas. There are few people who will wipe out their capital. The one who wiped out their capital, they will not come back to the market again.
Right, yeah.
सो देखो, ये वैसा है यार, चक्रव्यूह जैसा है, घुसते समय सब प्लान करना पड़ता है। एक
Right,
बार घुसे तो फिर वो एलोकेशन, ओनली थिंग, इवन आई हैव फ्यू बैड आइडियाज last few years, but the only thing which saved me is allocation.
right, right,
Even on good ideas, the only thing which matters after a point is your allocation. Even if his stock ideas is say 3-4x, but you didn't allocate a decent capital from your portfolio, it will not make a difference. You can write on social media that I made 2-3x, but it is not making a move in your portfolio because you didn't allocate enough on that idea.
right. Sure, yep. Thanks, Ravindra.
Moving to safer bet when things are not working is a better idea till your clarity in terms of growth comes back.
Thanks, yeah. Thanks for your views.
Yep.
We also have Yogesh sir with us. So Yogesh sir, you must be having some good question which we can ask from Ravindra. Over to you, Yogesh sir.
No, honestly, I mean, thank you, AI, but honestly, I don't have any questions for Ravindra. But thank you for arranging this. It was a pleasure listening to him and all other listeners who had questions. I also learned a lot. But honestly, I honestly don't forecast or speculate anything. So, Ravindra, I am a wrong person to be given the mic. Please continue. Thank you so much.
No problem. Yeah, thanks for connecting.
Likewise.
We have one more question, Raja Nagarajan. Yeah. So in the meantime, Ravindra, exit strategy you told about, like when it comes to buying. So what way you go about it? A staggered buying or lump sum? What kind of, and what kind of asset allocation you do? I mean,
At least say if I try to have something, say if I try to have something in my core portfolio where I will be planning something 7-8% kind of allocation of my portfolio, my bite size initially has to be 2%, 2.5%, 3%, so that I am interested in that stock. Yeah, if I only allocate where I am genuinely interested in keeping in my core portfolio, and if I only allocate 1%, 2%, वो track करने में interest भी नहीं आता. So staggered buying, you see that there is decent opportunity. You start with 2-3%, wait for 1 or 2 quarter, and keep on adding it. Market में opportunity मिलता रहता है. Nothing like आज गया तो कभी नहीं मिलेगा. Very few ideas would be such that which went out and you don't even see those ideas back. But otherwise, market keeps on opportunity, maybe on the same name or other name. You are not married to your ideas here.
right, right. And Ravindra, we often see people prefer, I mean, downward averaging, and they are averse to upward averaging. What view you have on this?
I have simple view on this. I don't see price. I see, say, valuation metrics. Say if it's a PE stock driven by PE, I will track price to earning multiple. Say Nestle 3 years back was at 10,000. I bought it at somewhere around PE of 60. Today it is 80. If it comes back to 60, I will buy again. I will not be bothered that it is 15,000, 16,000 price. Similarly, say HDFC universe we talked about. Right now it is 2.5 kind of trailing book. So rather than seeing the price, always track this valuation metrics. 2-3 valuation metrics you can always look at. PE multiple, price to book multiple, or EV EBITDA generally we use for industrials, but industrials it's very volatile. So you can take their 2-3 multiples at one go, P by B, dividend yield, what they are generating, and EV EBITDA, and see how the historical trend has been. Again, the same thing, last 8-10 years, and how they are quoting right now, what is the growth prospects, and then you see your entry point.
Yeah, makes sense to me. So next we have Raja. Raja, unmute yourself and ask question.
Yeah, thank you. Good evening, sir. So I request your opinion on pharma sector. So apart from About and Sun, I see all other pharma sectors are on, being bearish. So I'm a new entrant. So maybe your views and your ideas on pharma sector would be really helpful,
Yeah,
sir. Yeah, thank you.
I don't understand pharma and chemicals that much. Uh, the thing is, for pharma companies now to have a better grip, you need to understand. None of the companies are Indian pharma; they are global. You need to understand what's happening in the global market as well, and it needs a much deeper reading. But on pharma side, I would say I like few companies which say a company like Pfizer and all, which always trade at 40 ka multiple and do a decent 15 to 20% kind of profitability growth. I don't have any view on larger pharma space, but the few of the MNC pharma companies, you see that they normally trade in their same range, and the profitability has been very consistent for last 8-10 years. So if you see those 8-10 pharma MNC pharma companies, there is not too many significant bout of volatility like you see from Indian pharma companies, which is catering for US market and there is FDA regulation. It's very Pharma is very specialized sector. You say a particular company will say that I manufacture this drug which will be sold in US and Europe. You need to understand, apart from what the company is saying, what that molecule demand is in those geography. Otherwise, what we do in Indian market is we just go by company transcript. A company will say, "This is my drug. This has a potential market of $10 billion in US. In 3 years' time, I will have 5%, 10% market share." That's how we as analysts go about in terms of forecasting. But I think you need a much rather than doing that, you need a much deeper insight on that molecule uh, and the market where they are selling. And I so I'm from a commerce background. Yeah, it's very difficult for me to even understand those things. So no particular view on pharma companies. I look at few MNC companies where they available at attractive valuation, where I see that they don't have too much of volatility, I try to see if I can buy them. But then those companies also a bit difficult when you see negative news and holding on that, because yeah, I don't have any very concrete view in how they will do in next few years. So sorry, I'm not of much help, but yeah, that's limited knowledge on pharma side.
Thank you, sir. Thank you so much. Yeah.
So, Ravindra, we have a very important aspect in market, that is basically how we mitigate or maybe cut down on the risk. How to assess risk. I would like to hear about risk management, and I think FRM. You did FRM, right? So you must be the best fit to answer on risk thing.
Yeah, FRM though I did about more than 10 years back. But in market, how you gauge risk is, say you understand what kind of volatility your particular stock is, okay, and what kind of expectation from your particular stock, what kind of allocation you have. The only thing which can save you from bad ideas is allocation. Don't have overly allocate, because as a retail investor, many people do is 15-20% at the initial go in some bright idea they hear from someone else. That is utmost side of riskless character in terms of investment. Other thing is, keep on adding to your ideas. Maintain your 15, 20, 25 stocks portfolio. Keep on gauging 50, 60 stocks. If you are, say if you are investing in a large private bank, you keep on gauging what 4 5 others large private banks has been doing, whether your company is delivering up thoda upar niche, it's fine, but if it's delivering as per promise for many quarters, many years, that's how you gauge how the company is performing. And the other thing is, you keep on managing your allocation. If you go on too much of allocation on a particular stock, which is not actually widely been known in the market, then you run a very idiosyncratic kind of risk, because you are taking a bet which is very much unknown animal in the market, and you have over allocated there. Then you might run a like there is a downside risk which will be too high. But otherwise, if it's a decent name available at decent valuation, even a double digit kind of allocation, it should not hurt you. But you never know, yeah, disaster do happen even in the large cap names. But yeah, only thing which can save you on the risk side is, don't run towards the very fancy names which are very darling of the market in the recent bull run, and stick to core concepts of investing. Do investments in the sound companies when they are unloved, on the side of income.
I
Hello,
think we lost you, Ravindra. There. Hello.
hello.
Yeah, we can hear you. Yeah, go ahead.
Oh, I completed my answer.
Yeah, okay.
I,
So,
I should I repeat?
no, it's fine. Yeah, you're fine. So, one more question. I mean, see, we often see the bull and bear market are basically human behavior or human psyche driven, right? So, I mean, what would be your, I mean, suggestion or maybe opinion how we should go about the bull and bear phases of the market?
Embrace beer market. Yeah, that will help you to sustain. You can't unlove the beer market. That gives you a good opportunity to enter as well, and that is the cycle. You have to embrace beer market. Or one thing, the beauty about beer market is, if the bull market goes for a year, beer market will not last more than 2 3 months. If the bull market continued for 5 years, beer market की capacity बहुत limited होती है investors में. So say a bull market is continuing for 4 5 years, a bear market will be for 6 8 months. इतने टाइम में लोग साफ हो जाते हैं. The froth gets moved out. So embrace that bear market and keep on adding. Don't lever yourself. Leverage is the thing which will kill you. Don't lever yourself, and stick to core simple investing in a good quality name. You will make decent money here.
Right, right. So, Ravindra, any book suggestions you have on your part?
Books, so you can read a lot here. You
I mean,
can read Howard Marks. say there is different level of reading. I would say if you are starting reading on investment, something like Howard Marks, or अपने even Indian author, yeah, Manish Babrai and Basant Maheshwari books. Those are very good to start with. Saurabh Mukherjee, you will get a good understanding. If you want to dwell deeper into understanding, you can go to foreign writers, uh, Howard Marks, and those kind of thing. My personal preference for reading is I would read any number of time Nassim Nicholas Taleb, yeah, Black Swan and Fooled by Randomness. Even if you are reading these books twice, thrice, you will still love them. And his other book, Anti-Fragile, it's a very, very difficult read, but if you can read that material, it will help you in your investment journey a lot.
Yeah, I have those books in my library, but I am yet to get to them. A very good suggestion.
Yeah, anti-fragile. So even sometime it happened that I was reading and then I lost somewhere in between. I have to go back what I read. So it's a very difficult read. But yeah, Black Swan and Fooled by Randomness. At least you should read couple of times. It's a very very fun kind of reading. Other thing you can do is what I do is I listen to podcasts from Howard Marks. I used to like them a lot here. That is very good. Whenever I'm driving, it's 40-45 minutes kind of listening. It's a very good one.
Yeah, like the book Mastering the Market Cycles is awesome. I have gone through
Ray,
that book. That is great book, right?
yeah,
So,
yeah. Even say for cycle, you should even read Ray Dalio as well. Now he talks too much philosophical, but those elements, yeah, it's a like bouquet of reading. Reading Saurabh Mukherjee and Indian authors will give you a flavor of Indian companies. They will talk about what Indian promoters are doing, what kind of ROE Indian market generate, what kind of growth profile you see in Indian different sectors. Then you move towards, say, Howard Marks or Peter Lynch. You understand about basics of fundamental investing, how you look at stock, how you look at growth, how you look at debt and everything. And then you move to a something different level, which is Ray Dalio and Nassim Taleb. Yeah. Those thinking, it tells you more about risk rather than return.
yeah, so true, so true. So we have Raja with us again. So, Raja, any other question you have with you?
Hello, hello. Yes, Ravindra. So, Ravindra, so my second question is on IT front. So, my understanding, say, for example, let's say the market, large cap market such as TCS and these companies, they hold most of the government projects and also they are very big in size. And yeah, so it is the nifty stock. But there is also a saying called, say, for example, future IT, say, for example, the happy minds or some AI or ML based IT are also budding up. So the
Yeah.
people generally prefer towards that. So but what I feel is that would really take much more time to be implemented on real time, and when we start to taste the fruit of labor in that I mean in that high tech it. So what do you prefer, like I mean to just go with the future it or with the I mean the very strong it what we have currently, and just your opinion on that.
Sure. The first thing is on the large behemoth. I think they trade at a much premium valuation. Again, the same thing. You see what they used to trade as an average. Everything in market works in cycle here. 4 5 years back, no one wanted to touch IT companies. Now everyone says that this is cash churning machine. First. I am talking only about the large IT companies. You see what they used to do in last 8 10 years. The valuation for every IT companies, even after that 10 15% correction they have seen, there must be at least 50% higher multiple. Must be at least 15% higher multiple. The large IT companies which have product offering where you will have an employee cost which is 40 45 50 55% of their revenue. What I sense is what has happened is because of COVID, lockdown, and everything, they had cost saving directly, and lot of the projects from the customer side get front ended because they were heavy on the digitization and everything. You might not see the similar kind of growth, and your margin will shrink from here. What they have seen in FY21 was their highest kind of margin. Now you always hear about the labor cost going up, the attrition, and those things will hurt them. So that is one view on the large IT side. that you need to be cautious and you need to be keep on watching the development, because the valuation is also very frothy compared to what they used to be on 8-10 years back. The second question is on this new disruptive IT companies, SaaS, CPaaS, those companies. Uh, I also don't have very strong understanding. The thing I see them is, say, someone was conveying to me that these would be the next behemoth from the market. It can be the next big idea, but for my allocation in the next big idea is to be commensurate to the next big idea. I can't have them as a larger portion in my portfolio. I will have a smaller portion and see that if it's next big kind of idea, at least for next year, it should generate 20-30% kind of, I'm not saying stock return, but revenue should move in that direction. It can't, if a large behemoth is growing at 12-15% and you are next big idea, you has to grow at 25-30%. If they saw me that kind of growth, I will have an initial small allocation. I will not have big, because all these things are very disruptive. You don't know which will be the final winner, whether it will be from the listed company, whether it will be someone from outside. But yeah, you can't ignore that space of new age IT companies. Have a smaller allocation. If you understand them well, then you can have a larger allocation as well. If you understand their product offering, which is very much required, which can change the market landscape, and it's very much accepted among the customers, because what we hear is mostly the feedback we receive from the company side. None of the company will say that my product is subpar to my competitor. But if you are in that sector and you understand that product and tells you that, and your understanding tells you that yeah, it is competitive enough, will find its market, then you can have a higher allocation. Otherwise, keep it small there.
Yes, yes, yes. Thank you, Navindra. Thank you. Yeah.
Thanks, Raza, for your wonderful question. And Ravindra, I think we are done with the questions. It was really an insightful and interactive session. We really loved the knowledge you shared with us. Any closing remarks or any suggestion to the new entrants to market?
New entrant, I always say, don't go whole hog in the market. Start with passive investing, index fund. Understand about market. Then only, and at least now one thing which I found, it's very binary. Few newcomers I find that they invest very small amount, which will not be even their 1 month salary, and they keep on gauging stock prices. It's better than to focus on your core work. You will get much higher increment at the end of the year. If you're investing, have at least, say, a single idea should be at least half a month salary, 1 month salary. Okay. So you bite enough so that you are interested in that. There is this binary kind of dislocation I find, that people say that they read a lot about the company, but then the investment is 5,000, 10,000, which doesn't move a needle, even if the stock is double. So newcomers, the first thing is have a decent allocation on passive investing. If you are investing, read well enough. Don't read news item. I can share a few ideas where you can source information. There is a website Trendline where you will find initiation reports. There are lots of Telegram channel where you find research reports. On Screener you find con call. On YouTube there are enough channels where you can listen to con calls. At least listen to last 7, 8, 5, 6 con calls for the particular companies you are investing. You will get to know your company much better rather than reading news item. News item never helps. So those are the homework which you have to do, and have a decent allocation on passive investing. Start building on your capabilities with your own personal investing, like active investing from your own side, and gauge yourself. Yeah, those are
Yeah,
my
really
tips.
wonderful. So thank you, Ravinder, for sparing time for us. It was really wonderful, and we will have another round of Twitter Spaces with you to know more insights on different sectors. And I would request the audiences kindly connect with our handles and go through the YouTube channel and various insights shared by Ravindra at his handle. And we will really appreciate your love connecting with us. And it is all about learning and earning. We together as a big family learn market insights and we can implement those in our lives. Thank you, Ravindra. See you some other time.
Thanks, AI. Thanks
Thank you,
everyone
buddy.
for sparing your
Okay.
time here. Thanks.